Hello and welcome to ET Now. You're watching Earnings with ET Now, and my guest today is Puneet Chhatwal, who's the MD and CEO of the Indian Hotels Company. Puneet, thank you very much for joining us today. A good set of numbers coming in from your end. Can you take us through the quarter, how it has been with respect to occupancy and the revenue per room, average revenue per room?
Thank you, Sajid. I think the most important part of this quarter has been the acceleration of our growth. Buying into and completing the deal with Atmantan, which happened, the signing happened in the Q3 and the completion happened last month. I think we have really grown our brandscape, which is the platform for growth in RevPAR in the total revenue in the years to come. So the RevPAR growth has been good, is around 9%. The top line growth year to date is around 17%. And we expect going forward 12 to 14% top line growth, which should translate into a good flow through into EBITDA and profit after tax in the next few quarters to come, and then we'll keep guiding as those quarters go by.
Puneet, you did two acquisitions. You've been consolidating that as well. I just want to get a picture, a broader picture from you, how these two acquisitions will lead to a better RevPAR for you and maybe a higher realization going forward.
See, one of the things that it does to the acquisition is it gives them a home in terms of a brand. And we think the Ginger brand repositioning and reimagination has been one of the best success stories that we have had in the mid-market space in India in the recent years. So if 85 to 90% of the recent acquisitions of A&K and Pride successfully convert to Ginger branding over the next 12 months, and with some asset management initiatives, we think the mid-market gets a fantastic footprint through Ginger pan-India, and then it is a very good platform to scale from 200 plus hotels to 500 or 700 in the next 10 to 15 years. And mid-market is very important. It's a 500 million addressable population in India that uses hotels and will be using hotels in the years to come. So Taj remains Taj. Taj is our crown jewel. Taj is our global jewel. Is a crown jewel from India, made for India and made for the globe. But I think it's well supported now going forward with our flight kitchen business in TajSATS, as well as the mid-market business, which is Ginger, and the other brands will follow as of next financial year.
It's interesting that you're, concentrating on the mid segment because the growth is also going to come in there. Will that also help you increase the RevPAR in this segment beyond 3,000 rupees? What is the kind of optimal RevPAR that you see for this mid segment?
See, a few years ago, the same segment RevPAR was like 2,000. And now it has jumped to 3. Very soon it will be 4. In the major metros, it's already around 6 or 7, even with the Ginger brand. But in this segment, scale is important. The absolute growth and the crown jewels in the portfolio will keep coming in the form of Taj or other boutique luxury brands that we have launched in the last year. That includes Claridge's collection, as well as post-completion of the bridge deal, which is expected to happen by end of March. So both boutique luxury and luxury will drive the RevPAR growth forward, and also our international growth with Taj. But as I said before, very well supported by Ginger, which will continue to grow by leaps and bounds, both from a scale perspective, from a revenue perspective, and will also keep driving the RevPAR more towards 4,000, 5,000 for the entire portfolio.
From a city point of view, Puneet, Hyderabad, Delhi, and Mumbai, NCR or Delhi NCR seems to have a softer growth this quarter. Is there a particular reason for that?
A lot is dependent on the way the delegations work out. Now, I think as we speak, you're at the Global Business Summit of ET in Delhi at the Taj Palace. By the time you finish this summit, Taj Palace will be preparing for the AI summit, and a lot of heads of states are expected to come. As all this is happening, the Taj Mahal Mumbai is preparing for the visit of the French head of state, which is President Macron. So a lot of these activities are dependent on how the foreign delegations work, how the events pan out. Last year, there were other events in the month of December, which boosted the revenue of December. Same thing is expected in the month of February. So as long as in the 12-month period, you keep getting 3 or 4 extraordinary months, 3 or 4 very good months, and then the rest could be good or okay. It helps you to get to double-digit top line growth, which on a very high base that we have is a big number. So if we talk about 10,000 crore revenue as a base, for example, or 5,000, the 10% on that is a very big number. So I think for our sector, I think as the largest hospitality ecosystem, given the confidence in the guidance that we have been providing for last 3 years, we are very confident that we can maintain double-digit growth in the years to come.
How do you look at the luxury segment? One view of the street is that, your RevPARs are growing at a good rate, but it's still trailing some of your peers who are solely into the luxury space. Is there enough room that you see for RevPAR to go up in that segment as well?
You are absolutely right, and the people who have spoken to you are right. The only problem is they should also look at the absolute number. Percentage is not what you take into a bank account. The Taj brand is at 22,000, which is the highest among anybody else. So I think from that number, if others are having a higher growth, that is good because that makes our positioning with those high rates and RevPARs on a more consolidated front, and we will never be under pressure to discount those going forward. I think that's the way to look at it. What is the base? And then look at what is the percentage growth.
Um, I just want to talk to you about the management fees part of it. It contributed nearly 8% of your hospitality revenues and is growing at 15%. A large of new, lot of keys are getting added in the next 2 years in this segment. Do you see the growth to remain in the mid-teens, or it can cross 20% odd threshold as well?
Well, we would strive to cross and aspire to cross 20%, but anything between 15 and 20 is a very high growth because, as I keep saying, the base keeps getting larger. Important is to see where it was. It was not even at 1/3 of the level that you see today 5 years ago. So I think this model gives us faster growth, but also helps you to balance the portfolio in terms of what is owned and what is in fee income in terms of the service that we provide. And I am very pleased because we have 250 hotels in pipeline. Our capital light percentage of the portfolio in the pipeline is 94%. So 94% of our estimated growth, save for any kind of acquisitions that we might do, is going to come on a capital light basis, and that means the growth in management fee income is going to be exponential in the years to come.
And that would mean also a lot of EBITDA growth coming in and EBITDA increase in EBITDA margins as well?
See, when you are a very high growth driven company, and we tried to explain that yesterday also in the investor call, we opened 2 hotels on our balance sheet in the last quarter. And also, we had opened in the last year the Cochin International Airport. At the same time, we are preparing the opening of the Taj in Frankfurt, which is a lease. So there are a lot of upfront expenses. I think important and interesting is that we have been able to absorb all those expenses on due diligence, whether we bought Atmantan or we bought A&K Pride or we did Bridge or legal expenses or travel expenses, and maintained both a growth in absolute amount of EBITDA as well as our margin, despite the scaling. And that's why we call it, scaling up with profitability.
My understanding is that from 19, 20,000 odd keys which you have or which you will have by March this year, you're going to scale it up to beyond 25,000 by next year. Are we on target for that?
No, I think, Sajid, I have to make a little correction here. We are today across the world, when we include international markets, at around 32,000 keys in operation, and our pipeline exceeds 30,000 keys. So our estimate for this year is around 6,000 keys, and that's the kind of a base we are looking at going forward. And what we have said, anything on an organic growth basis, 40 hotels plus is realistic for the next financial year. This year we land anything between 34 to 35 hotels open. And when we add inorganic part to it, I think another 20 would be realistic. So I think next year will be the first time in the history that we'll open 50 plus hotels in a financial year.
Which also means that FY 27-28 will be a big year for you with respect to the kind of scale up that you're going to see with respect to number of hotels and keys you're managing, but also from a revenue point of view as well, right?
We are aspiring and hoping that, save for any geopolitical factors or factors beyond our control in the macroeconomic space, we are very confident of having a great year because of the acquisitions we have made, because of the openings that are lined up, because of all the pipeline that we have built over the last 5 years, and the change in the business model, which is expected to drive top line growth as well as ensure profitability and margins going forward.
My final question is with respect to return on equity, which you've been focusing on as well. And it's around 16 odd percent for this year. Do you expect that to go to 18, 19% in the next 2 years as you scale up and you bring in more managed hotels as well as your own hotels will come in FY 28?
Absolutely, under Accelerate 2030, which is our strategic plan and the roadmap for the next 4 5 years. We have guided for a return on capital employed of 20%. We maintain that guidance and we hope to achieve that definitely by 2030, despite company-owned projects opening up, as well as other conversions of hotels into, as I mentioned before, by virtue of the acquisitions we have made, into Ginger or other brands in the near term.
Puneet, how do you see the demand coping up? I know you are focusing on the mid segment because that's a very chunky area where the demand is much higher there. With respect to demand and supply, how do you see the industry at this point in time? Is the industry coping up with the kind of demand which is there? And as a result of which, do you see a pricing increase upwards, a buoyancy for you for your pricing as well?
Demand is continued to outpace supply, and in high demand periods, the ability to charge is also quite good for the sector. I don't see much changes happening on that front because it takes time for supply to get built in India. Because of a variety of reasons. And in the next 2 to 3 years, demand should continue to outpace supply. At some point, it will balance out or even out, but I think with the way we have done our brandscape, we address all price points, all segments, and I think the fair point here to say is Taj, being an absolute luxury brand, is not dependent so much on scale. But if you are participating in mid-market growth, scale is very, very relevant. So if you have to become an important and dominant player in mid-market, then the scale is important. So that's the focus on scale is with the mid-market, but our main backbone for the company yesterday, today, and in foreseeable future is obviously the Taj, which accounts for 69% today of the total revenue of our portfolio.
Puneet, it was a pleasure talking to you today. Thank you very much for giving us a perspective on how Taj and Indian Hotels is scaling up. Thank you for joining us on ET Now today.
Thank you. Thank you for having me. Always a pleasure.